This is Free to Exchange, the show where free markets and free-thinking scholars meet. I'm your host, Ben Powell. Ever since the financial crisis and the Great Recession, more and more people are coming to the view that America's banking system is broken. But what can be done about it? Today I'm going to be joined by two economists who believe that the banking system is over-regulated by the government and that market forces might better regulate the system. On the first half of the show, we'll discuss problems associated with deposit insurance and what alternatives might work better. Then, on the second half of the show, we'll discuss how competition can create a self-regulating banking system. My first guest is Dr. Thomas Hogan. Dr. Hogan is Assistant Professor of Finance in the Johnson Center for Political Economy at Troy University. He was formerly the Chief Economist for the U.S. Senate Committee on Banking, Housing, and Urban Affairs. Tom, welcome to the show.
Yeah, thank you for having me on.
So, deposit insurance, most people have a vague notion that their deposits at U.S. banks are insured. What is it actually that it does?
Yeah, that's right. So in the United States, we have an agency, the Federal Deposit Insurance Corporation, the FDIC, that insures deposits at commercial banks in the United States so that if the bank fails, depositors are still able to get their money. And they are charged a small fee for that you probably don't even know about. Most people are unaware they're being charged a fee for this insurance. But it covers up to $250,000, and that's an amount that has increased over time. Prior to the financial crisis, the limit was $100,000, and then they raised it so that $250,000 in your bank account is insured by the U.S. government.
And the kind of standard story on this is that it dates back to the Great Depression when banks were collapsing, and the argument was that otherwise sound banks, depositors just got scared, started taking out money, and then it was a self-fulfilling prophecy that the banks collapsed. So we needed this insurance so people wouldn't make a run on the bank.
Yeah, that's right. It's the idea is that deposit insurance will help prevent bank runs and financial contagion. And so the way that it's supposed to work is that because people know that their deposits are insured, if their bank gets into trouble, they don't run to the bank and take all their money out, because if that happened, then it might cause the bank to fail. Even if the bank wasn't going to fail, if people just thought that, then they would do it. And if you see one bank fail, then you think, oh my goodness, my bank might fail too. And people would run to the bank and take all the money out and the bank would fail. And so in that way, it might create this contagion effect where banks that were healthy were failing just because people were afraid. And so if your deposits are insured, you don't do that because you're not worried about getting your money back. That's the sort of standard textbook lesson that we tell to high school students and everything.
I got a feeling that you don't buy that.
I don't think so. In fact, I think most economic historians that have studied this think that that's really not what happened during the Great Depression. There's a famous paper by Calomiers and Mason that's in the AER, that's the top journal of all of economics, and they look at banks that failed during the Great Depression to see, was this a bank that made bad investments and so that's why it failed, or was this a bank that failed because of contagion, because people were afraid and they ran on the bank and took their money out. It turns out they're basically all because of bad investments. They failed for regular fundamental reasons, and there were some bank runs, but those were on banks that were going to fail anyway. Mm-hmm. And so there's really no evidence of this story about financial contagion. That's a reason they established the FDIC, and it's, like I said, the kind of standard story that people tell, but there's really not a lot of evidence for that.
Now, even if that's the case, that's not what happened in the Great Depression, it's still possible that could happen. So maybe it's not a bad thing to have, but you think there's more to it than that.
Yeah, that's true. So on one hand, deposit insurance does prevent bank runs. People don't run on the bank if they know they're going to get their money anyway and that it's insured by the government. On the other hand, it's well known that deposit insurance causes the problem of moral hazard. That is, banks, because they know depositors are not monitoring them or not going to run on the bank, they can take a little bit more risk than they otherwise would. They don't swing for the fences and just invest in all kinds of risky stuff because they still have owners of the bank that are equity investors, and the managers don't want to lose their jobs, so that they don't take a ton of risk, but they take more than they normally would. And so on one hand, we're preventing bank failures by preventing runs. On the other hand, we might be increasing bank failures because banks are now taking more risk than they normally would.
Right, so you just did the classic economist thing, right? Where
right.
The President Harry Truman said, I just want a one-armed economist, so you can't say on the one hand this and the one hand that.
Yes.
So how do you adjudicate between these two hands figure out which one dominates?
Yeah, so in theory, we don't know which one of those effects is going to be stronger. And so we have to do studies of the real world to see, okay, which one of these effects is bigger? When we have deposit insurance, or when we increase the amount of deposit insurance, do we see fewer runs because fewer failures because we don't have runs? Or do we see more failures because banks are making more risky investments?
So when you look across the globe, not everybody has the same type of deposit insurance as the United States. So what do you see juggling these two hands?
So there are, I would say, 3 strands of research in this literature. One of them looks at individual countries and says, over time, if that country increases their level of deposit insurance, what happens? Do they have more failures or do they have fewer failures? They almost always find there are more failures when we have higher levels of deposit insurance. So the United States, Germany, Russia, Poland, there are about a dozen studies of individual countries where they say what happens over time. The other thing that you mentioned is every country does it a little differently. And so we can look at around the world, how do the different deposit insurance systems work, and do countries that have more deposit insurance have more bank failures? It turns out the evidence from those 2 strands of the literature are very conclusive. They almost always find that more deposit insurance and more government involvement in the deposit insurance system lead to more bank failures, and at the national level, more financial crises. And so when we look at countries around the world, the United States is one of the few countries where deposit insurance is entirely run by the government. Almost all other countries, or at least the majority of developed nations, have some kind of private or semi-private system, and those tend to be more efficient at preventing bank failures.
And the other way we can look at it, because right from the start of this show, we talked about that this came in the Great Depression in the United States. So presumably we could look at bank failures in the United States pre and post, and when we've increased our limits.
Yes, so that is, I said there are 3 strands of the literature, and then I mentioned 2, so that's the third one. Okay. Is that prior to the establishment of the FDIC, and even especially prior to the establishment of the Federal Reserve in 1913, Federal Reserve, that's the central bank of the United States, before that, there were a lot of different systems run at the state level. Banking regulation was mostly done at the state level, and some states had government deposit insurance systems, and others had none at all, that were all run privately. And so that might be something like a banking organization that the banks get together and insure each other. It might be a clearinghouse that clears the payments between banks and acts like a banker's bank. And those private systems tended to work a lot better. When we look at the United States, when we look at the individual states and compare them, we find basically the same conclusion, that states that had more government involvement in the deposit insurance system, or higher levels of deposit insurance, had more bank failures.
So after thinking about this for a while and looking at these cases, what are the reforms that you'd recommend for the U.S. deposit insurance system now? Maybe starting with the easiest type of reforms that we can make.
Yeah, so I think that the evidence from the literature leads to a couple of simple reforms that we could make. The first one being, we can just reduce the amount that we're insuring in terms of deposits. I mean, $250,000, right? Like, who needs $250,000 insured that they have like that much money sitting in cash? It's not a lot of people. Most Americans have, the majority of Americans have less than $5,000 in their bank account. I think it's something like, I can't remember the numbers, but 80% have less than $10,000. And so if we set the level of deposit insurance at something like $25,000 or $50,000, we would be covering almost all Americans in the amount of money that they keep in the bank.
But for the bank's bigger depositors, those bigger depositors would have more of an incentive then to watch what the bank's doing.
Right, exactly. So those people that are keeping hundreds of thousands of dollars in cash in their bank account, they're a lot more worried about whether the bank's going to fail. And so we would see that they would be worried about bank failures and monitor the bank more strongly.
So to take it a little bit more radical then, because I run the Free Market Institute at Texas Tech, if we were going all in free market reform in this area, what would that look like?
Yeah, so changing the administrative side on deposit insurance, one thing is that we could just get the banks involved with running the deposit insurance system, because they know whether other banks are taking risk. They would be more active about auditing it. Or we could just completely privatize the whole thing. I mean, we do have private deposit insurance in the United States. If you want more than $250,000, you can get private insurance for your deposits. And there are a lot of companies that do that already. Obviously, when the government raised the level from 100,000 to 250 that's covered, that squeezed out a lot of the private insurers. But evidence shows that the private insurers are better at monitoring banks. They audit something like 65% of their banks every year rather than about 15% done by the government, because they care. They will lose money if the bank's going to fail, so they monitor more carefully whether the banks are taking a lot of risk.
Do we have examples of this? So we've done it on the margin in the United States above 200, or what used to be above 100,000 and now above 250. Do we have anybody who's just pulled it and said no government insurance at all private?
Right. So there are two pretty close examples of that. The truth is that most governments today have some kind of government requirement. Even if it's mostly private system, the government is involved. Prior to the financial crisis, there were a couple of countries, mostly Eastern countries, so Singapore, Hong Kong, Australia, New Zealand, didn't have deposit.
Good free market economies, I might
Free
have.
market countries did not have deposit insurance prior to the financial crisis, and were basically pressured into adopting it. Since then, Australia has dialed back theirs a little bit. New Zealand has completely abandoned that system. They have no deposit insurance now. They do have a government agency that is willing to freeze bank assets if the bank looks like it's going to fail. So they have some kind of system to protect depositors, but no insurance. Another similar system was that prior to 1998, Germany didn't have a government deposit insurance system. It was all private. They were pressured because of the EU, right? Joining the EU, they wanted to standardize all those systems, and so studies show that their private system worked better than the government one they have now.
Of course, Germany is like the rock of best banking in Europe.
Right, and so we had to ruin that by requiring them to have a government system.
All right. Well, thank you, Tom, for joining me and explaining all of this today. I appreciate it.
Yeah, thank you for having me on.
Coming up next, how market competition could regulate the banking system. We'll be right back.
Free to Exchange is a joint project of Texas Tech's Free Market Institute and Texas Tech Public Media. More information is available at fmi.ttu.edu.
Welcome back. Joining me now is Dr. Lawrence White. Dr. White is professor of economics at George Mason University and a member of the Mercatus Center Financial Markets Working Group. He's the author or editor of 8 books, including The Theory of Monetary Institutions and Competition in Currency, that are related to our topics today. Dr. White, welcome to the show.
Thanks, Ben. Great to be here.
So let's start off with kind of just basically, what do we want a banking system to achieve for society?
Banking systems do 2 things mainly. One is operate a payment system, making it easy for people to buy and sell. And the other is to come between savers and investors. So they pool funds from people who are saving for their future and entrust those funds to people who have good investment opportunities.
So what would be the standard argument of why we need to have a government central bank to regulate such a system?
It's a little hard to answer because the argument is pretty much a black box. We got a Federal Reserve System in the U.S. because there were a series of financial panics in the 50 years before the Federal Reserve Act. But the problem wasn't inherent to the banking system. It was because we badly regulated the banking system and made the banks weak. In other countries, the ones I've studied are Scotland and Canada. You didn't have that kind of banking system weakness, and there was nobody calling for having a central bank. In some other countries, central banks were created to lend money to the government cheaply. I mean, that was their job.
So we've had a central bank for more than 100 years now in the United States.
Right.
People kind of just take it as a given. How do you think it affects the ability of the banking system to do what it's supposed to do? Is it a positive, a negative influence, or why?
Before the Federal Reserve, we had a bad banking system because we restricted the banks. Since the Federal Reserve came along to make money cheaper for banks when they're in trouble, and on top of that we got federal deposit insurance, now we've weakened the banking system by giving them privileges, by making life too comfortable for them. So I think it's hurt. I think banks, well, one, they spend a lot of time and effort just obeying the paperwork requirements of the Fed and the FDIC. But the banks have accommodated themselves, especially the large banks, to a system in which they can take big risks and they're pretty sure that they're too big to fail.
So actually that leads into then our recent financial crisis in the United States and the role of the banking system in that. How much of this do you think is inherently a problem with banking that's just prone to fits of optimism, pessimism, what have you, and how much of it was a direct result of either Federal Reserve or other government regulation?
I think it was about 99% Federal Reserve and other regulation of the banking system. There were mistakes made in the private sector, and some banks were more prudent than others. But when you see the whole industry going on a binge, you have to ask who spiked the punch bowl. And it was the Federal Reserve, by making credit cheaper than it otherwise would have been. The Fed famously held interest rates too low for too long. They were worried for no good reason about deflation, and so they kept the foot on the accelerator long after the previous recession. And that's when the housing bubble built up. And it was a housing bubble because we had all kinds of crazy mandates to subsidize housing. We had Fannie Mae and Freddie Mac with mandates to make loans that were not really creditworthy. And then the speculative bubble blew up because of that.
Sure. So let me, I have two questions to follow up on this. One of them, let me put on the statist economist hat that I've heard from others. It was deregulation, and in particular, the only one I can think of is the Glass-Steagall Act was deregulated, and that has some responsibility for this. What is that, and why do you think that view isn't the 99% or more than the 1%?
So there was a modification of Glass-Steagall. Glass-Steagall separated investment banking from commercial banking, and also separated commercial banks from insurance and other lines of business. And that was modified back in 1999 to allow banks to be part of a financial holding company together with investment banks and insurance companies. I don't think that had anything to do with the financial crisis, because the investment banks that got into trouble were not aligned with other businesses, with commercial banks. They did it the old-fashioned way by making bad loans. Mm-hmm. And the fact that banks were now allowed to affiliate with investment banks actually helped in some of the rescues to make it possible for commercial banks or the commercial bank holding companies to buy out the investment banks. But in fact, we probably overdid that. I mean, the Fed forced some mergers of firms that should have been resolved, should have been liquidated.
Right. This was the market was starting to sort that out until the bailouts and forced mergers kind of came.
So the worst was the Bear Stearns rescue, where the Fed illegally, in my view, injected $30 billion to sweeten the deal for J.P. Morgan Chase to buy Bear Stearns. And when the people at Lehman Brothers saw that, when the people who were lending billions to Lehman Brothers overnight saw that, they said, oh, well, it's not risky to make these loans because we'll get bailed out the way the Bear Stearns creditors were. And so
this is spiking the punch bowl.
Lehman Brothers actually ratcheted up its leverage after that.
Yeah. So the other thing that you said in your previous answer was the Federal Reserve kept interest rates too low, too long. Right. How do we know what interest rates should be?
Well, it's difficult. It's kind of a central planning problem, and the Fed doesn't have the knowledge to set interest rates in any perfect way. Really, they shouldn't try. They should leave interest rates to the financial markets. And as long as we have a Fed, we have to figure out what's the least damaging policy they can follow. And I don't think it's targeting interest rates. I think it might be just trying to keep the flow of spending in the economy more or less stable. So, but they have a real forecasting problem, which not because they're more foolish or less informed than other people, but it's just impossible.
So this actually brings me to the question then of getting away from the Fed then, what would a competitive banking system look like, and how would that find the right interest rates?
Well, before the Federal Reserve, we had gold and silver standards with banks issuing everyday money, paper currency, and checking accounts based on redeemability for gold and silver. And nobody was setting interest rates. There was no interest rate policy, but financial markets determined interest rates through competition of borrowers and lenders. And that made it a more self-regulating system rather than relying on some experts in authority to try to fix where interest rates ought to be this week.
So the interest rates came about as just a market process of borrowers and savers.
Like they do in bond markets.
So what was wrong with that system?
I think it was the best system we've seen. I don't think there was much wrong with it, except, as I said, the banking system in the United States was weak. But if you look at some other models, I mentioned Scotland and Canada, nobody thought there was anything wrong with it. When they decided to have a central bank in Canada for political reasons, the bankers were all against it.
So how did it work? What time period are we talking about in Scotland or in Canada, and how did those systems actually work?
So this heyday of the Scottish system was in the early 19th century. There was a law passed in 1844 that kind of closed off the free entry and made it less competitive in order to bolster the power of the Bank of England. In Canada, they didn't get a central bank until 1935. And as I said, the bankers were against it, but the politicians thought it would be a good thing to have so that they could send a representative to international conferences of central bankers. They felt left out.
So, and this relates to a little bit of what we talked about in the first half of the show about deposit insurance. I think one people's fear is that the Fed is the lender of last resort, and this is one of your other mechanisms to prevent good banks from failing when everybody gets scared. And my first guest had said he didn't actually think good banks failing was really part of the Great Depression. But how in a competitive banking system does that get prevented?
Well, good banks could have liquidity problems, need a little cash that they don't have. If they're in a position to pay back a loan, somebody will lend them the money. The decision about whether they're creditworthy ought to be in the private market, not made by a government agency, which is going to be all too ready to rescue bad banks, which ought to be closed because they're squandering the depositor's wealth. So that's how it sorts out in a market. And the agencies that were in the best position to know whether a bank was solvent were the commercial bank clearinghouses. The banks were members of the clearinghouse, had the clearinghouse kind of examining their balance sheet, actually sending in bank examiners, because as a club of banks, the other members of the club wanted to make sure that nobody was going to default at the clearinghouse. So there was a kind of self-regulation, a self-inspection that put the clearinghouse in a position to say, hey, every other bank in the clearinghouse, this guy has a kind of random liquidity problem. Can we lend him some money? And they would agree to do that because it was good for all of them. It was kind of a self-insurance system. But they had the incentives to do it right.
So what was wrong with the incentives in the banking system prior to the Fed? You mentioned a couple of banking crises that we had. What was wrong with it there?
We had a restriction on branch banking. Banks were limited to one state, and in many states they were limited to one office. So banks were very poorly diversified. They were a typical bank would be lent to just one industry, like in Texas to the oil industry only. And we saw the results of that in the oil price crisis, where like 2/3 of the banks in Texas failed. So that was the main problem. There was also a restriction, this is a little bit technical, but on banks' ability to convert deposits into currency. When the public wanted currency, instead of making it easy, the way it was in Canada, the restriction made it a drain on the bank's reserves. And so every fall, when farmers wanted to pay their farmhands, gold would drain out of the system, and then there would be a crisis.
So in just the last few seconds here, the world we live in today, we've had the Fed for 100 years. How would we move towards a more competitive banking system today?
Wow, that's a tough question.
Especially in just a few seconds.
So we've got a moral hazard bomb in the form of deposit insurance, and it's important to clip the wires in the right order. If you took it away tomorrow, there would be runs on the banks the next day. So we need to figure out a way to phase it out and give the banks time to get back into a sound portfolio, sound balance sheet, prudent banking, so that we can make them rely on their own resources.
All right. Well, thank you very much for joining us today.
My pleasure.
The banking industry is one of the most regulated industries in our economy, and yet it's still prone to crisis and problems, as the recent financial crisis illustrated to us all. Many people think that it needs more government regulation. My guests today have pointed out that maybe it doesn't, and that at other times and places, banking systems have had much less government regulation and performed better. They don't argue that it needs no regulation, but that market forces might better regulate the banking system by providing better incentives to make sure for sound money management throughout the system. I think they're right. I'll see you next time.